financial statements provide a comprehensive picture of a company's financial health. The balance sheet is divided into three main sections: assets, liabilities, and shareholders' equity. Each of these sections gives insight into different aspects of the company's financial situation. Assets represent the resources a company owns and are expected to provide future economic benefits. Assets are typically classified into two main categories: current assets and non-current, long-term assets. Current assets. These are assets that are expected to be converted into cash or used within 1 year. Key examples include cash and cash equivalents, cash on hand or in the bank, and highly liquid investments that can easily be converted into cash. Accounts receivable, money owed to the company by customers for goods or services delivered on credit. Inventory, goods available for sale or materials used in production. Prepaid expenses, payments made in advance for goods or services to be received in the future, e.g., rent or insurance. Non-current assets. These are long-term assets that are expected to provide economic benefits beyond 1 year. They are typically used to support the company's operations. Examples include property, plant, and equipment, P&E physical assets such as land, buildings, machinery, and equipment. Intangible assets, non-physical assets, including patents, trademarks, and goodwill. Long-term investments, investments in other companies, bonds, or other financial instruments that are held for more than 1 year. Liabilities represent obligations or debts that the company owes to others. Like assets, liabilities are classified as either current or non-current. Current liabilities. These are obligations the company must settle within 1 year. Common current liabilities include accounts payable, money the company owes to suppliers for goods or services received but not yet paid for. Short-term debt, loans or other debt that must be repaid within a year. Accrued expenses, expenses that have been incurred but not yet paid, such as wages or taxes. Non-current liabilities. These are long-term obligations that are due after 1 year. Examples include long-term debt, loans or bonds that will be repaid over several years. Deferred tax liabilities, taxes that have been accrued but will not be paid until future periods. Pension liabilities, obligations related to employee retirement benefits. Shareholders' equity. Shareholders' equity represents the owner's claims on the company's assets after all liabilities have been paid. It is the residual interest in the company's assets and can be thought of as the net worth of the company. Common stock. This is the value of the shares issued to shareholders. It represents the initial investment made by shareholders to provide capital for the company. Retained earnings represent the accumulated profits that the company has reinvested in the business rather than distributed as dividends to shareholders. The balance sheet provides a detailed snapshot of a company's financial position at a given point in time. By analyzing its assets, liabilities, and shareholders' equity, stakeholders can evaluate the company's liquidity, leverage, and overall financial health. When combined with the income statement and cash flow statement, the balance sheet provides a comprehensive view of the company's financial performance and stability.